Okay, this is just a quick little video about Warren Buffett and how his model applies to the game of cash flow and assets. And first things first, here's our website at 1millionjobsnow.com. You can find out information about the book, Building a Small Business That Warren Buffett Would Love, which is on Amazon.com and BarnesandNobles.com. And here's our presentation. And so I was just going to go over real quick Warren Buffett's fundamentals, the picture of cash flow and assets, the different class behaviors that you've probably seen in Robert Kiyosaki's books, the definitions of examples and assets that lead to financial independence, how Warren Buffett's business model can fall into that framework. It's very important. The three quadrants of earners that Robert Kiyosaki talks about, the game of cash flow, and then any questions. And all this kind of fits in the paradigm of financial independence. So let's talk about Warren Buffett real quick, and here's the book, Building a Small Business That Warren Buffett Would Love, which is on Kindle at Amazon right now, but the hard copy will be available March 12th, 2012 on all major bookstores and on Amazon.com and BarnesandNoble.com. So the Warren Buffett fundamentals include investing from a business perspective, but as it relates to small business, looking at your business through the eyes of Warren Buffett. So he likes a consumer monopoly or a toll bridge, and what that means is a business that has real distinct brand recognition. If it disappeared from grocery shelf stores tomorrow, you'd notice, like Coke. If Coke was gone from Kroger tomorrow, you would notice it's missing. Want to see a track record of earnings. So this means you really need to be tracking your P&L, and you need to see those earnings coming out. I mean, that makes sense, and everybody wants earnings. That's easier said than done, but a good Buffett-like business, even a good Buffett small business, will have earnings, a steady, consistent, and growing track record of earnings year after year. And leading to the next point, you have a high return on those, a return on equity. Basically, if I was running a business and I had a 5% return, but I could go buy a fourplex that had a 10% return, why wouldn't I just take my money out, barring all the tax consequences, and go put it in the fourplex? I mean, the return is, how hard your money, or in this case, how hard your equity is working for you. Retained earnings means that you have the ability to take that money and put it back into the company or back into that high return earning machine. So a company that can't do that would be like more of a commodity type business, is how he refers to it. A company that, its cash is eaten up in R&D costs or retooling costs. So that's something to look for. You need the ability to raise your prices with inflation. This can be important if you have shares, because as earnings go up, but the number of stocks outstanding remain the same or decrease, that means the earnings per share can potentially go up. So you keep up with inflation. Like a ticket to Disney World back in 1960 cost $3.50. They obviously have the ability to keep up with inflation. I think tickets for a one-day pass are in the $50 range nowadays. Low levels of debt. This is kind of a no-brainer in a lot of ways. And people use debt for leverage, but that can go both ways. And he likes to see a company that can pay off its debt in 2 to 3 years straight out of its earnings. So low levels of debt. Happy margins, happy business. What that means is, again, it kind of comes back down to that net margin or that profit. You want to see that. You want to see good gross margins too. You want to see a business that's not being eaten up in cost of goods sold. And all that can be applied to small business, and that's what this book is about. Building a small business that Warren Buffett would love. Now, how does this apply to the overall paradigm of financial independence? Get rid of that. So if you've read Rich Dad Poor Dad, you've seen this chart before. And these are your financial statements represented graphically, which is kind of nice. It kind of gives us something to wrap our brains around visually. You have your income statement on top, or P&L, same thing. You have your balance sheet on the bottom. And income minus expenses equals the profit, and assets is equal to liabilities plus equity. I think I got that right, didn't I? Yeah, if you had $100 in assets and you owed $50 against that, and you have $50 in equity, right? So, so this is kind of a way to think about your finances and your business. So financial independence, according to Robert Kiyosaki, which is not a bad goal to strive for, but what does it mean exactly? It means that we have enough cash flowing assets that deliver income into our income column that we can meet our expenses. So in this case, I know this is hard to see, but this person has $2,000 a month in expenses, and their assets are delivering $2,000 a month in income, passive assets, so they're technically financially independent. Now these are Robert Kiyosaki kind of described, I think this was in his book, The Cash Flow Quadrant. It talks about how the different classes spend. So this would be a person that doesn't have the ability to invest any money. Their income comes in the door and it goes right back out. You're living paycheck to paycheck. Basically just expenses. There's no breathing room here, right? This could be like gas money, food, utilities. It's gone. There's no wiggle room at all. The middle class, on the other hand, they're really good about getting credit for toys or doodads, as he calls them, and buying jet skis and going down to the whatever, your local electronics store, running up credit there. I guess this is not going to go away. And what that does is this credit or these liabilities down here create expenses. I have a monthly expense on my jet ski, and therefore my income comes in the door, hits against that, and then it goes out the door. I really like to keep up with the Joneses in the middle class. The rich, on the other hand, and rich, you can use that however you want to. I think maybe you say rich with time or rich with assets is not necessarily to have a connotation of snobby rich, but just I think financial independence equals more security for your family. So the rich have enough assets to be financially independent. So coming back to the security thing, if worst case scenario was to happen, if somebody lost your job, then you would be okay in this situation, technically, money-wise, because you have enough income coming in from your asset column to meet your expenses. You got 4 basics now: food, clothing, shelter, and health insurance, right? So those would definitely be covered here. So now let's talk about what goes in that all-important asset column. So there's an accounting definition of an asset. I think basically that's what something is worth, right? Like the value of it. The liability is what you owe against it, and the equity is the difference between the two, right? I think an asset is everything you own, a liability is everything you owe. But in our framework of financial independence, an asset puts money into our pocket, ideally on a monthly basis. If it's a dividend paying stock on a quarterly basis, it's relatively passive. I know that sounds too good to be true, but we'll talk. You're already investing in assets like this anyway. If you have mutual funds or a 401k, maybe not so much a 401k. It's harder to get that money out, right? But you're already doing it. So this isn't pie in the sky, non-reality. You'll see in a second when I get to the examples what I'm talking about. Relatively passive, doesn't require a presence to continue to generate cash flow. Thus, in a lot of ways, it's a system. So our examples include cash flowing rental property. If you own a fourplex, and after all the repairs and the taxes and insurance, and if you cover any utilities, yard work, and the interest on the loan payment and the principal piece of it too, if it cash flows after that, that's passive cash flow. If you get a property manager, it's really passive cash flow. Dividend paying stocks, that's where the quarterly comes into play. But if you see a stock that has a 7% yield, and you put $100 into it, then you can bank on $7 a year in passive cash flow. You divide that out by 12, so you see how much you kind of need in that situation to deliver X amount of dollars a month. Covered call options, that's where you're actually writing an option, a contract against a stock, and somebody could buy it at a specified price. So that's, I always, I think on this, getting back to Warren Buffett, is make sure you own a stock that you'd want to be invested in. Otherwise, if you weren't writing a call option against it, because there's always this underlying, just the underlying value period of the asset. You don't want to just buy something just to generate the cash flow, because you could lose your shirt in the depreciation of the asset, or the in the stock market, just, I guess, a bum company, it has no future. A business system, the traditional ones that might be like a coin-operated laundry facility. Also, book royalties could be in here. You name it. Capital. One thing that's not in here is, and one thing that Robert Kiyosaki kind of rails against, is capital gains from stocks and mutual funds. In theory, if you think about it, if you had a mutual fund that averaged 10% a year, averaged, over a long term, in theory, you could bank on a 10% cash flow a year from that. Now, he doesn't like those, because he says, well, that's not cash flow, that's capital gains. It goes up and down. But rental property delivers a rate of return, right? Maybe it's 10, 12, or 15%, whatever it is, but that's what you're considering the cash flow. The same thing on a stock. The capital gain could be considered that. The only thing you have to be aware of is, in down years, you have to have some sort of cash sitting around to be able to weather a down year in a stock. So basically, you see how you're already, if you're in mutual funds or 401k, you're already buying a cash flowing asset in a lot of ways. As far as business systems go, Michael Gerber really details how to systematize a business to make it where it could run based on a system and not based on a person being there all the time. Not that this all sounds like, how can I go home and sit on the couch? It's not about that. It's basically building a business that's not so you dependent, because the second that you do have to step out, it falls apart. So check that out. But I always get back to the Warren Buffett model as well. Kiyosaki covers the 4 quadrants of earners, and the fact that if you do own rental property, you have the ability to legally get your tax percentage down to 0. Taking the appropriate legal tax deductions, portfolio income at 20%. I'm sorry. Then earned income, that means if I earn a paycheck, I get a lot hacked off. He claims up to 50%. So you see, a person earning $50,000 in passive income and taking the legal tax deductions is equivalent, has an equivalent income of $100,000 at the earned income level. So that's why that's such a big deal. The benefit of a business is, again, kind of come back to why that passive income is low. If you flip this chart upside down, here's our income statement and balance sheet again, but over here is our income statement of our business. So we have our income, expenses, and then you pay tax on what's left over. Individual, you get a paycheck right off the top, taxes are taken out, and then you spend on what's left over. Business, you earn an income, spend, and then taxes are taken out of that. So there's a thing called expense shifting. Legally, if you qualify expenses as business expenses, such as travel and mileage expense and home office and office supplies and all that, then cell phone, computer, then you reduce this income that otherwise you would have had an expense anyway, right? Now you're using it for business purpose, lowering your tax bill. Again, the idea of financial independence is we're taking our asset column down here, we're stocking it full of assets, hopefully not overloading on liabilities. Everybody, we can talk about leverage all day and what that means and if it's good or bad, but basically you're paying down, or you're building these assets to deliver income. And a good personal financial plan is, the Dave Ramsey plan is, sock away an emergency fund of $1,000, pay down all your debts, smallest to largest, start investing in mutual funds, pay off your house, build a college savings fund for the kid. But he agrees with Robert Kiyosaki on reducing these bad liabilities. They both agree on that. At least where they differ is where Robert Kiyosaki, Rich Dad Poor Dad, would say, I want to use as much leverage as I can in buying rental property. And Dave Ramsey says, no, don't ever use it. So, but where they cross over is pretty important because they both agree on, hey, you shouldn't have a lot of debt on jet skis. It just, you're losing money, it's creating expenses. And then they also agree that you should build assets. And Dave Ramsey says build mutual fund assets, and Kiyosaki says, focus on rental property and passive cash flowing businesses. And then if you're going to do stocks, maybe you should look at the Warren Buffett way, which kind of brings us back home to the Warren Buffett fundamentals and building a small business that Warren Buffett would love. He when he buys a stock, he's buying a business, and sometimes he's literally buying the whole business. But a business is an asset. It fits right down in here. And, if you buy a stock the Warren Buffett way, in my opinion, you're buying an asset that delivers cash flow. He considers the earnings his at the end of the year. He wants those companies to reinvest those earnings. So that's how he doesn't pay taxes on his, he just gets capital gains. But he wants those companies to retain it because if it's Coke, for example, and they're delivering a return on equity of 18%, he doesn't want them to give him the money. I mean, what are you going to do with it? Are you going to go out and go to your local bank and invest in a CD for 4% when Coke could have kept it and reinvested it back into their business model? So they keep it, they reinvest it, and that's where I was saying a stock or even a mutual fund that holds stocks like that can be considered an asset that's delivering that income. And building a small business that Warren Buffett would love. Let's just go to the website real quick. If this will work, I think I can just get out of here. Probably be easier. But so building, you can take those fundamentals that he looks for in great businesses, and they can be applied to a small business. So, consumer monopoly, that's basically branding. In your small business model, that's basically making sure you have distinction in your local market. Earnings, that's just, really that's having the ability to read your profit and loss and make sure that you're generating this growing level of steady earnings over time. That sounds easier said than done. That's what everybody wants, right? But through this book, you'll learn how to apply that, how to fix your earnings if they're broken, and track them going forward. Retained earnings, making sure you have the ability within your small business to reinvest those earnings. Checking your return on equity. If it's low, then we need to make better business decisions about how we're spending our money and the return that those, those different spending strategies are generating. Anyway, that's all detailed in Building a Small Business That Warren Buffett Would Love. It's available on Amazon.com and BarnesandNobles.com right now, and the Kindle version is available on Amazon right now. Also, as part of our campaign, you may have heard of Tom Shoes, how they give a pair of shoes away to a child in need for each pair sold. We're kind of echoing that with the unemployment rate. We know that's an issue in the United States. The unemployment rate's getting better, but it's sitting at about 8.4% with 13 million people unemployed. With each book purchase, we're going to give an ebook away to a person looking for work, and see if we can have an impact on that. And that's what this website is about, 1millionjobsnow.com. And that basically wraps it up. We covered everything. These are the websites, 1millionjobsnow.com. You can find us on Facebook if you just search at 1 Million Jobs, and Twitter under My Happy Assets. Again, the book's available on Amazon and Barnes & Noble. If you want to send in any questions or any comments, I guess you can leave them on YouTube or go to probably our Facebook page if you like the page, and then if you leave any comments or send me a message, we can do it that way. Thanks so much.